Okay, so today what I thought I would do is talk to you about the three different primary strategies that I see people going around raising capital today. And what I thought I would do is this is based on a few conversations I've had recently, one of which was with a gentleman that was looking to raise capital. And I realized after the conversation that he probably didn't understand the full landscape. And that's really on me because I think unless you're in the business of raising capital, it's easy to, not easy, it's difficult to understand the different options. And so what I thought I would do is give you the three different options that most people will eventually fall into. And then I'm going to show you really how I raise capital, which is quite different than what I would say the majority of people out there would even be aware of. Okay. So first, a caveat, just because my lawyer would kill me if I didn't do it. And that is none of this is tax or legal advice. Definitely talk to a securities lawyer and make sure that you are properly covered off if you're going out to raise capital. And this is just going to be based on my experience, both personally and then from mentors of mine that have been raising capital in the kind of 9 and 10 figure range. Okay. So with that out of the way, let's jump in. Okay. So I've got notes over here. That's why you're going to see me kind of looking over every once in a while. I'm going to apply names because it's the easiest way for me to just kind of recall in my head who these people are as it relates to the capital raisers. So the first individual, and this is a guy that I literally had a conversation with, I think it was on Wednesday. We had a Zoom. No, maybe it was Tuesday. Anyways, and this is I'll name him Donald, although that's not his real name, but it's pretty close. And this is really for people that are like institutional level. Okay. So there's a couple of people that have even contacted me. Funny enough, I was shocked because they've got $50 million, $100 million of transactions that they've completed, and they're looking to raise capital. Those type of individuals could probably go to a guy like Donald because they have the track record, and really a guy that has that kind of experience could meet with smaller institutional money, family offices, and really what Donald, the capital raiser that you would be hiring, is what's your track record, who's your team, and is the story compelling enough? And if those things line up, then they say, you know what, we're going to put the deck together for you. We're going to tell your story. We're going to line the meetings up, both institutional and retail investors. And in exchange, you're going to probably pay a flat fee up front. I don't know what that number is going to be, but let's say it's anywhere from probably minimum 50,000, probably more like 100 grand, just to kind of put all the material together. They're looking to likely help you raise anywhere from 30 to 100 million. And they'll probably charge a 4.5% to 5% performance or success fee on the back end, right? So if they raise, I don't know, let's just pick 10 million. That would be very low, but the numbers are easy. 4.5%, 450 grand. But they're usually not raising 10 million. They're usually looking to raise 50 million. And so you can start to see what the numbers look like. Okay. So this is like, in a best case scenario, they go out, they line it up. You are essentially on a roadshow, right? You're going to be out and you're going to be doing a lot of work to raise that money because they tee those meetings up and they will be present and they'll coach you. But ultimately, it's you that's selling the story. And nothing wrong with that. In fact, most people that are at that level, they are probably the best ones to tell the story. All right. And so generally speaking that you would raise the $50 million, and you're just, on the road a lot. The worst case is, unfortunately, the story doesn't land well. And you spent probably $300,000 between legal, setting the pitch deck up, going around for 12 months to raise capital. And unfortunately, you only get 25% of the way there, 30% of the way there. And you'll probably get what I call like an MBA in how private equity works, and maybe not do it again. So I can say that because I've went down that path and it was very frustrating. But I know other people that have done very well with it too. So just kind of, like I said, none of this is like it works 100% of the time. If it did, everyone would fall into one of these categories. The next is more of, so the first is like the professional at an institutional level. What I would say is the next is going to be professional at a retail level. And the gentleman that I'm thinking about here, I'm going to use the word, his name, Jordan, not his real name, but pretty close. And this is someone that has a very good network of high net worth investors and has built those relationships up over time. And he's mainly focused on not losing money, which means he's looking for people that have great track records. Probably not the first time they've raised capital. They've probably, in that, probably on the very low end, $10 million of experience, but probably closer to like 20 to 50 million. You can also think of like crowdfunding platforms that do a lot of this kind of stuff in the US, like CrowdStreet, Fundrise. There's a couple others that are not coming to memory right now, but they're looking for a track record. And generally what they do is you're responsible for your pitch deck, you're responsible for presenting, but they will put you in front of high net worth investors, okay? They're going to vet you, they're going to vet the team, and they're going to vet the deal, right? A lot of times they will fly down, they'll go look at your opportunity, they're going to interview you. They're really going to get to know who you are because their reputation is based on making sure that they pick winners. And so the first time that they present and put a deal in front of their investors, the people that they've spent 10, 20 years cultivating those relationships with, if they lose money, then they could be out of business. So they're hypersensitive about making sure that they only work with people that have a really good track record. I would say in a lot of these cases, because I've gotten to know some of these individuals, generally they're probably 1 in 10 people that they meet with actually pass the sniff test, that they would actually say, you know what, I like you enough that I'm going to trust you to go in front of the investors. So just kind of keep that in mind. They typically will charge like a 5 to 6% flat fee. Some will charge more. I've seen some charge as much as 8 and 10%. Usually the people that are charging more have less criteria for the type of investors that they're representing. That's just been my experience. So in a best case scenario, working with these type of people, let's say you raise $5 million at 5%, $250,000. You're probably not going to really build a relationship with those high net worth investors, because if you think about it, the professional that put you, the investor, in front of this group of people with money, they're going to want to keep those relationships because that's their business. Their business is essentially going out finding operators like you, if that's what you're after in terms of raising capital, and making sure that they only put operators like successful operators in front of their group of investors. And so they're going to be very protective about keeping those relationships, which if you're an operator, you're constantly having to go back to those individuals to put you in front of more investors, if you will. In a worst case scenario, maybe they only raised $1 million. You needed $5 million, so you're $4 million short. So now you're going to have to either raise the money yourself, the other $4 million, or what I've seen is the deal comes apart. Now you're you get the reputation of not being able to close, and so you really can't go back to that individual again to be able to raise money for you, and it's just a really negative situation, because unfortunately now this group that raised you $1 million expects to get paid 5%. They put a lot of time and energy, and yet there's no money to be able to do that. And so there's, just it's unfortunately a situation that I've seen a few times, and I'm not going to get into what happens because sometimes it's legal and it's just not a good thing. The last example, if you will, of raising capital that I see, and this is probably unfortunately what I see quite a bit, more and more lately. And if you're on LinkedIn and if people know that you have the capacity to raise capital, you'll get a lot of messages. And what's happened over the past 6 to 12 months is probably on a weekly basis, I'll either get emails direct, or I'll get phone calls, or I'll get messages on LinkedIn asking if I want to invest in someone else's deal. And it can either be direct from the operator or the investor, the developer. We'll just say the developer for now on, just because that'll be the easiest. Or it's someone that works with the developer and they're just a hustler. And I'm not going to talk about the legalities of raising money for someone else's deal, because unless you're an exempt market dealer and you have the like the legal right to be able to go out and raise capital, like according to the Securities Exchange, and it varies depending on the province and country and all the rest of it. So I'm not going to get into that side of things. Generally speaking, a lot of these people are walking a very fine line as to whether or not they can even raise capital. But let's take the legality out of it. One of the major issues with raising money in this kind of fragmented, kind of bootstrap way is that it comes across very unprofessional. And typically what ends up happening is the deal is flogged out. And I've seen where 3 people all over the country are sending me the same deal. And when I see that, I know A, they have no control. B, they probably haven't done a lot of the due diligence to really understand the deal. And C, they're probably going to get paid a big fee if they can get the money, because the developer is aggressively trying to raise money. It means they haven't been able to do it on their own. And so they go out and find someone else that can help them. And I get it. I understand, that situation. If you're, you've got a deal, you've got a tight timeline, you love the deal, but you just don't have the experience to be able to raise the capital, you're scrambling. And if someone says, hey, I've got connections, or hey, I'll work for you for free for the next 3 months to raise this $2 million, $5 million, and I've got a big network, well, their network is LinkedIn. And I can tell you that, just because I have 3,000 connections on LinkedIn doesn't mean I know 3,000 people. And yet those people will be blasting out 100 messages a day. Hey, would you be interested in putting 100 or $2 million or whatever the number is into this opportunity? I haven't seen it work. I'm not saying that it can't, but it's certainly not what I would rely on. And just kind of on that, I've talked about it in the past, but it's like a very spray and pray, meaning like it's just throw as much crap against the wall and see what sticks. In a best case scenario, you do raise the money. But think about the type of people that are coming into your deals. You have no relationship with those people. Unfortunately, there's probably, like high expectations, because if you're not controlling what is being told and promised, I've seen many situations where investors are being promised very lucrative returns, no risk. People are using, terms that I would never recommend, like guaranteed. And unfortunately, you as the developer, you don't know what is happening in those conversations. And so when those investors now come in and you inherit them, you are going to potentially deal with people that have been given improper expectations. And so I would just be hypersensitive. I would never do it, frankly, myself. But if you're in that type of situation, I would just caution you, because I've seen it happen several times where people are told one thing by the promoter who really doesn't have a vested interest. They're just concerned about getting their 5% or 10% fee, or maybe some sort of a carried interest in the deal. And unfortunately, it generally doesn't work out well. So I think I've talked about the problems there. And unfortunately, in a worst case scenario, you just don't raise the money. And once again, you're kind of in a situation where you've spent probably a lot of time and energy. People are counting on you to close on that deal. And if you wait to the last minute because someone promised you, hey, I've got investors coming in, and then when the time comes to get the money wired into your lawyer's trust account, it doesn't happen. You can have brokers, a lot of people that have spent time and energy, your team that was counting on that deal to come together, and it doesn't. It's just a situation that I've seen firsthand. From people that have kind of contacted me recently. And it's, I guess the solution in my experience, and obviously I'm biased, but this is really what I see people at a very high level raising capital. Even if they're going down the institutional route, they still do what I call club syndications. Now, they don't call it club syndications, but essentially it's like a group of high net worth investors that will come into your deals because you've built a relationship. Now, I know what happens with developers and investors. I'll just use developers that haven't maybe raised capital in what I call a club syndication. They think, well, I don't have the connections. I don't have the relationships. Where do I even get started? How do I structure the deal? What do I put in front of them? What should go in my pitch deck? I mean, a lot of that I cover in my book. And I mean, you can get my book, I think, on my website still for free. I'm going to change that because I just know that people that pay for it will pay attention. But as of today, the recording of this, I think you can still download it. And it's like 50 pages. So at a minimum, you're going to get an understanding of how I structure my deals, how I raise capital. And like I said, it's not the only way, and it's not necessarily quote unquote the best way. But if you study how, and I've been in this business now for about 12 years raising capital, this is a strategy that I've kind of refined and tweaked for my own personality and experience, but it does work very well. And the reason I think that it does work as well is a few things. Number one, I'm not relying on someone else. I'm in control. Okay, that to me is critical. Number two, I'm building relationships. The relationships that I have with my investors, like the last two deals I raised capital for, and you know, it's in the mid 7 figures. They were done primarily from emails and text messages. A few people I got on the phone with, but they were short conversations. But it's because I have that relationship and that track record. Now, initially, it doesn't start like that. You got to put a lot of energy and effort in up front, but now it's paying off. And then typically those relationships, then they will refer other people. And the people that they're referring, obviously, are going to be high net worth investors that are predisposed to coming into your deals. So it's a very different type of conversation. And I guess if I was to give just the best advice that I can, it's number one, start as early on as possible to build that platform, and so that you've got the relationships with people cultivating now, right? I had one of the conversations that I had with Donald, I'll call him, earlier this week is I said, look, I don't know why you don't have a podcast. I said, like, you send me amazing newsletters and information, but unfortunately I'm so busy I don't have time to read that. I said, if you just spent 15 or 20 minutes, you and your partner, talking about it on a weekly basis, I could consume and get to know you even at a deeper level. Like, I know you as a person, but I would imagine a lot of other people want to know who the real Donald is, right? You're a family man. You're just like an incredibly hard worker. Like the deals, like he's really the only person that I've ever invested outside of real estate with, because I have that level of trust and respect for him. And so I'm probably going to have him on my podcast here in the next month or two. But the concept is that you're building your OPN, something Ryan Fletcher talks about, one of my coaches, own personal narrative. And that is, you're able to build trust well in advance of ever asking for something from someone, right? If you need to raise money in 30 days, then it's going to be difficult, right? The reality is, it's just and I've been in those situations, but I can tell you that it's, if you're scrambling to raise a bunch of money in a short amount of time, you're just at a disadvantage, because you could potentially come across as needy. Whereas if you start today knowing that you're going to raise money in 3 months, 6 months, 12 months, you take that long-term approach. You start to build up a community, and people get to know you. Even the people that are closest to you, they get to know, oh, I didn't realize you were doing developments. I didn't realize you were buying apartment buildings. And you start to just talk about what it is that you're up to, educate people, build that trust. By the time that you actually need money, and you've deposited and you've given so much, that as long as people believe in what it is that you say, there's a high likelihood that that they'll come into your deals. There's never guarantees, because A, your deal might be junk. B, you might have a shitty track record. C, the team that you've put together or the market just doesn't justify it. However, if you stack the odds in your favor, then you're going to be in a much better situation to be able to raise that capital. So hopefully all that makes sense. I got to go skiing. My family is waiting. And so, look, I think probably the call to action today, if you want to call it a call to action, just get my book, Club Syndication. Go to my website, shanemelanson.com. Pick it up, download it, read it. And at a bare minimum, you'll get a high level understanding of how club syndications work, doing limited partner, general partnership type structures. Like I said, it's not the only way. It's not the best way. It's what's worked for me. I can only speak from experience. I've seen the other three approaches. I've tried two of them personally, and they can work. Just understand you're paying big numbers for someone else to raise money. And frankly, for me, I'd much rather be in control. And yeah, it takes a little bit of energy and effort. But if this is the business that you're committing to be in, then it makes sense to put that energy up front, because it's going to, you can leverage it into the future. Whereas if you're always having to rely on someone else to raise money for you, you're always at subject to whether or not they even take you on. And I've seen people change their minds, right? Maybe one day you're the flavor of the month, and the next day they're like, you know what, we've got someone else that we're raising capital for. They've got a better deal. They're in a better situation. So sorry, we can't take your deal on right now. So that's it. Take care. Bye for now.